Welcome to the Jill on Money Show. It's Thursday, October 31st. And no, this is not the Halloween special. As we have previously discussed, Mark and I, not the hugest fans of Halloween. Hope everyone is safe out there. Hope you steal all your kids' Snickers bars. That's what I would generally do. Anyway, this is the program that takes the mystery out of your financial life. And we do that by having you ask questions of us. Just go to our website, jillonmoney.com, and click the Contact Us button. When you write us that note, that's the email we receive. If you would like to join us on the air live, all you need to do is check the box. Executive producer Mark Talercio will do everything else. Today, we're going to tackle a few of those emails. We're going to start with Rob, who writes, each year I max out my 401k contributions through a defined percentage of my bi-weekly paychecks. I'm at a point now where my annual year-end bonus, which I receive in April, is large enough that I could allocate most of it to max out the annual contribution to the 401k. I could see a few positives to this approach, such as it will allow me to have more take-home pay in each paycheck for the rest of the year. But I'm sure there are some pros and cons that I could be missing. I would greatly appreciate your advice as to whether or not you think the approach is a smart idea. Thank you as always and love the show. Rob, I'm with you. Take that money out immediately. I guess the one downside would be if you put all the money into your 401k and then the market plummets 5 days later, it's not going to be a great year. But over the long term, stock markets tend to go up. So I'd rather get all of my money working as quickly as possible. I hope that helps. Here's a note from Anonymous. Anonymous writes, I have recently been laid off as part of a corporate restructuring, and I'm going to be receiving a generous severance package. I will receive a lump sum payment of about $200,000 gross early next year. I will not be able to contribute any of that lump sum into my 401k. I'm over 50 and I generally max out my 401k each year into a Roth 401k. Since this is not permitted with my severance, any suggestions as to what I can do with a portion of that to minimize my tax hit next year? My severance will be taxed at around 23 to 25%. I'm not sure if there's really anything I can do. I do plan on finding another job at some point next year, but I will be using a portion of my severance to live off of until I get that new job. Okay, Anonymous. The thing is, you weren't receiving any sort of tax preference with your 401k Roth contribution. I guess the question is whether this lump sum payment is considered earned income. And if that's the case, perhaps, depending on whether you're married or not, you may be able to make a Roth contribution. But maybe it just doesn't matter. Maybe you should create a brokerage account, keep enough money set aside so that you can pay for your expenses until you get a new job, and invest and have that account serve as a supplemental retirement account. If you want more information about this, feel free to get back in touch. This note is from Mark, who writes, I listen to your podcast a lot, and I've taken your advice on many subjects. You finally convinced me that paying my mortgage down at 3.125% interest is done. But what about a boat loan? I still owe approximately $55,000 at a 5% interest rate, and there are 14 years remaining. Financially, we're pretty set. Our household income is $240,000. We live in the Midwest. I could pay the loan off now with part of our liquid funds, about $125,000 total. But I've always enjoyed using other people's money when possible. Does it make sense to pay extra on a loan like this, since the return on pretty safe investments is about the same 5%? FYI, I have been doubling my payments each month to shorter the duration and cut down on some of the interest expense. Well, Mark, I think that you might be onto something here. First of all, it's tough to find a 5% interest rate right now because we know that the Federal Reserve is starting to cut those interest rates, and that reduces the amount of interest you have on your liquid assets. I feel like you do, which is 5%. It's not terrible, but it also is not something that you necessarily want to pay. So I would definitely accelerate this. If $125,000 is a lot more than you need as part of your emergency reserve fund, then maybe even pay more than that. Maybe take 10 or 20,000 of that. But yes, I agree. Paying down that loan at 5% probably makes sense. This is from Delilah, who writes, how does my daughter avoid probate? She's my only child. Do I need a trust? I live in Florida. Okay, Delilah, every estate, every will has to go through a probate process. So I presume that your daughter is the executor of your will, and she would then present that will and go through the probate process with your assets. But I think what you're trying to ask is, how can you make sure the money can get to her more quickly? And that's a little bit easier. First of all, anything that has a beneficiary designation, like a retirement account or an insurance policy, that will pass to your daughter via contract. You can also title your accounts that are non-retirement accounts at many financial institutions with a transfer on death designation, meaning that if I were to die, my daughter gets this account, and that account would avoid probate. What would not avoid probate would be your possessions and your house. So those would be assets that must go through the probate process, and it probably does not make a lot of sense to put your daughter's name on the deed, because that may put her in an unfriendly tax situation upon inheriting the house or the condo in which you live right now in Florida. This is from Donna, who writes, I have a question about how and when to pay federal and state taxes. If I were to convert in December, can I wait until April of the following year to pay the tax out of my non-retirement savings account? Or do I have to pay quarterly by January 15th? Also, can I roll over at any age, provided I am in the income tax bracket that I'm comfortable with? Well, according to Mark, who wrote a note to me, that if you were to convert in December, you do not need to pay quarterly tax. You would just have to pay the bill when you file your taxes in April. And no, there is no age limit when it comes to doing a Roth conversion. So as long as you understand that that money has to be kept aside outside of retirement to pay the tax due, you should be in great shape. Here's another email from that very big family, the anonymous family, who writes, I'm a long-time, everyday listener. My husband is 65. I am 64. I am totally burned out and I want to retire in March of next year. My husband makes $160,000 with potential bonus of $20,000. I make $153,000 with a minimum bonus of $20,000. He would continue working for the next 2 to 5 years. Our assets include my husband's IRA, $1.4 million, my IRA, $216,000. My husband has a 401k with a Roth component that's worth $107,000. I have a traditional 401k that's worth $447,000 and $100,000 in a Roth 401k. Our brokerage account is worth $514,000, and we have $182,000 in a high-yield savings account. We have a condo that has a $700,000 value and a mortgage of $290,000 at 2.99%. We have no other debt, our 2 kids are launched, and we spend about $14,000 a month. My Social Security benefit at age 67 is expected to be $3,200. At age 70, it would be $4,100. His is $3,800 at 67 and $4,900 at age 70. Can I leave my very stressful job in March? Anonymous, it looks like you're golden. When I look at these numbers, here's what I see. I see a lot of assets that have been saved. Yes, a bunch in pre-tax money, so that is important. But I think that for the next couple of years while your husband is still working, perhaps he should pull back on his retirement contributions a little bit to help with your cash flow. Otherwise, what you can basically do is use your brokerage account to live on until you guys claim your Social Security. Now, presuming that you guys are both in good health, you wait till age 70, maybe you take yours at 67 and his at 70, we'll see where things go. But you've got plenty of money, you've done a great job, and there's no reason that you should remain in a stressful job because you've done the work to give you that get out of jail free card. So Anonymous, go ahead, take the plunge, be careful about the next few years, don't go crazy spending money, and maybe give us a holler back because we might think about pulling some of the money out of the pre-tax IRA or 401k assets before you claim Social Security. There will be an opportunity for you to either use that money to live on or potentially to convert it into a Roth asset. So maybe get back in touch with us. Good luck. Let us know how it goes and take a deep breath. You're on to your next phase. Okay, that's it. That's the program. If you've got a question, all you need to do is go to JillOnMoney.com, click the Contact Us button, and let us know if you would be willing to come on the air. Don't forget to sign up for the free weekly newsletter and get ready to join us for Jill on Money Live, our year-end webinar, where we are focusing on tax loss harvesting and using your winners to your advantage. We've got a special guest, Michael Goodman. He's a CFP and a CPA. He's going to help guide us. You can only be part of that webinar if you are a member of Jill on Money Live. It will cost you $35 for the next 12 months. Not exactly a heavy lift for you guys. I know that. But if not, okay too. You can subscribe to the show on the Odyssey app or wherever you find your favorite podcasts. Please leave us a rating and review wherever you listen. Try to do something nice for someone else today. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you tomorrow.